Hello and welcome to Mr. Curran's Ledger-ary accounting tutorials. Today we'll be focusing on the accounts involved in the accounting process. In accounting, you'll be recording general journals, ledgers, and trial balance for revenues, expenses, assets, liabilities, and owner's equity. Within this vodcast, there'll be tips for you to actually use to determine what are revenues, expenses, assets, liability, and owner's equity. So what are assets? Assets are anything of value that can be converted into cash and are owned by the business, individuals, and governments. Within accounting, assets can be classed as current assets and non-current assets. However, these will be discussed in future vodcasts and are only applicable for senior accounting in year 12. However, current assets are assets which can be converted into cash within a 12-month period. So examples of current assets are things like cash at bank, accounts receivable, or even petty cash. In order to determine what constitutes a current asset, you need to look at how quickly can this asset be converted into cash. So for example, a building may take upwards of 12 months or more in order to sell. Also, with a motor vehicle, may be hard to sell that as well. So that's why they are classed as non-current assets. Non-current assets are assets which are owned over a long period of time and are very hard to be converted into cash if you're wanting to sell them. So how do I determine what constitutes an asset? There are a number of clues when you look at transaction analysis to determine what the account actually is. For example, an asset is something that is valuable. So in other words, it is usually expensive. It is tangible, so something you can actually touch and feel, and usually lasts more than 12 months. So example of assets are things like cash at bank, accounts receivable, motor vehicles, buildings, furniture and equipment, computers, TVs, or any type of asset that is used to generate revenue for the business. The most common form of assets that are owned are motor vehicles, buildings, and computers or furniture and equipment. Another example that you need to determine is what is called inventories or stock. Inventories or stock are items that are bought by the business for resale. So if we consider an organization like JB Hi-Fi, their inventories or stock are the actual items that are on the floor of the actual building itself that are ready to be sold for the public. So they would constitute things like the computers, the DVDs, the PS5s, the Xboxes, the washing machines, or anything that's on the stock floor that is wanting to be sold by that organization. Now they are also classed as current assets. Liabilities, on the other hand, are amounts owed by a business to external parties. So the most common form of liabilities are accounts payable, and accounts payable are accounts where the organization owes money to another organization where we actually bought stock. Other examples could include loans, mortgages, credit cards, and the like. So the easiest way to distinguish what is a liability is, do we actually owe this person or an organization a sum of money? And if it is, then it will constitute a liability. As previously mentioned, the most common types of liabilities are accounts payable, who are people or organization whom the business owes money as a result of credit purchases. So if you see such words as bought on credit, or a name of an organization, or bought stock on credit, you'll know that account is an accounts payable. A loan, on the other hand, is money borrowed from a bank, financial institution, or another source in which to actually purchase some form of asset. So that could be taking out a loan to buy a motor vehicle, or to take out a loan to buy some form of computer or furniture and fittings. The main difference between a loan and a mortgage is a loan taken out by a business which is secured by assets, and it is a bigger liability than a loan. So for example, you would take out a mortgage to purchase a building or a block of land, as opposed to some simple furniture and equipment or computers. Revenues are income and services earned by the business. So such examples of revenues include services revenue, for example, a plumber coming out and unclogging a drain. It could be a builder coming out and fixing some form of repairs for a house or a building. Okay, so they're actual services provided by a person. Other examples could include doctors, going to the doctor, and also seeing an accountant to lodge your income tax return. So in other words, they are services provided by people. Now, to account for revenues, they are usually the amounts that are deposited in the cash or bank account, and as such, used to fund the day-to-day operations of the business. Expenses, on the other hand, are the exact opposite of revenues. They are costs incurred in the earning of revenue. So in other words, they are the expenses that are used in the day-to-day operations to generate revenue for the business. Now, the main types of expenses for this unit are motor vehicle expenses, so they include fuel, repairs, insurance and registration, rent expense, salaries and wages, superannuation, but they could also include such things as advertising and other forms of expenses that are used to try and generate revenue for the business. Owner's equity, on the other hand, is the value of any investment the owner has made in the business. So there are two types of owner's equity. One being capital, in which the owner invests cash or property into the business, or drawings, which the owner has a right to withdraw his or her investment in the business itself. Now, capital is the one in which the owner invests or puts money into the business, and that is the most positive form of owner's equity. Drawings, on the other hand, is when the owner actually takes items out of the business, so that could be either cash or stock, and therefore as deemed a negative owner's equity. So in essence, in order to determine owner's equity, you just look for the name of the business owner in the transaction and then need to determine whether the business owner is putting items into the business, for example, through a capital injection of cash or contributing assets or liabilities to the business. And drawings, on the other hand, is when you see words like withdraw from the business with the connection of the owner itself and things of that nature. Now we're going to test your knowledge. So you need to determine what the following accounts that appear on the screen. So what are computers? Computers are assets. So in other words, items of value that the business actually used in generating revenue for the business. What are wages? Wages are classed as an expense. So wages are items that we actually withdraw from the business itself and to pay someone for doing a service for the actual business. So it is classed as an expense. What is a loan? A loan is classed as a liability because it is an account which we owe money to the bank that we may have used to purchase assets or to generate income for the business to be used in the day-to-day running of it. What is services? Services are a revenue for the business. So services is the income or the services that we provide as a business for people in the community or businesses itself. So in other words, it's the income that is generated by the business in order to pay for the day-to-day operations of the business itself. So therefore, it is classed as a revenue. What about when the owner takes money out of the business? The accounting term that is used to describe owners taking money out of the business is drawings. So therefore, it is an owner's equity account. and it is a negative owner's equity because the owner is actually withdrawing money from the business, so therefore taking assets out of the business itself.